I'm sure that you have already heard about the extra 20% federal tax deduction that some business owners can take. Well, this deduction isn't available for every business owner. If you operate your business through a sole proprietorship, partnership, S corporation, LLC, trust, or estate, you may be able to claim the deduction. Now, there was a lot of confusion over whether real estate investors could take the deduction, so the IRS established a special safe harbor election for real estate investors. If you invest in real estate and want to know more about how to qualify to take the deduction, please click on the link above to watch that video. So, this limited time 20% deduction is called a qualified business income deduction, and is also called a QBI deduction or a Section 199A deduction. It's only supposed to last to the end of 2025, but Congress might decide to extend it. Although QBI is based on business income, the 20% qualified business income deduction is taken on your personal 1040 federal tax return, and it is not a deduction on your business return itself. Actually, only some trusts or estates can claim the deduction directly on their tax returns. Qualified business income is basically the net income from your business, but without investment income and losses, any income from outside the United States, and any income that cannot be allocated to your business. You can deduct up to 20% of your qualified business income plus 20% of any qualified real estate investment trust dividends and qualified publicly traded partnership income. Although the deduction is calculated on your business income, it will be limited by the taxable income on your personal return. The total taxable income on your 1040 personal tax return from all sources will be counted to determine if you will be able to actually take a QBI deduction on your personal return each year. Based on the type and amount of your 1040 taxable income, you might be able to receive the full deduction, a reduced deduction, or no deduction at all. That is where the qualified business income deduction limits come into play. Actually, there are 3 limits that you have to consider. But before we get into the limits, I want to let you know that we will discuss some tax strategies later that you can use to try to avoid going over the limits. Also, you'll definitely want to do some tax planning before the end of the year to make sure that you maximize your QBI deduction. It is really difficult to strategize after the tax year closes. So the first QBI limit is an overall limit. The QBI deduction will not be more than 20% of the taxable income on your personal return after you subtract your net capital gains income. This limit takes into account all net income from the flow-through businesses that you operate and income such as your W-2 wages. For example, if your business income is $100,000 and the taxable income on your 1040 personal tax return is $50,000, your QBI deduction would only be $10,000 instead of $20,000 due to the taxable income limitation. The next 2 limits are based on your actual taxable income amount. For 2023, if your 1040 taxable income is at or below $182,100 for single filers or $364,200 for joint filers, then you will get the full 20% deduction. Again, the deduction will never exceed 20% of your taxable income. The third limit is if your income for 2023 is over $232,100 for single filers and $464,200 for joint filers, your type of business, the wages that you pay to your employees, and certain business assets that you depreciate can reduce or eliminate your QBI deduction altogether. If your business offers personal services and your taxable income is over the third limit, then you cannot take a QBI deduction at all. Personal service businesses include professions such as health, law, consulting, athletics, actors, financial or brokerage services, accounting, or other businesses that mainly depend on the reputation of the employee or owner. If you are not a personal service business and your taxable income exceeds the third limit, then your QBI deduction will not exceed the greater of A, 50% of your share of the W-2 wages paid to employees, or B, 25% of wages plus 2.5% of the initial cost of your depreciable assets. As you can see, if you're above this third taxable income limit, and if you don't pay much in W-2 wages or you don't have a lot of depreciable assets, your qualified business income deduction will be small. So here are a few strategies you might be able to use to increase your W-2 wages. If your business is using independent contractors for services, you may want to hire employees to do those services instead. Of course, if you hire more employees, you would have to pay payroll taxes and possibly other benefits, so that means that your business will have more expenses that you may not want to take on. Another thing that you can do is increase wages or give bonuses to employees at year end. If you are an S corporation, you can increase your wages as an owner too, but if you don't have a change in duties or a change in the amount of work that you perform, then the IRS might say that the salary that you received in earlier years was too low. Then you will be assessed payroll taxes along with penalties for underpaying yourself in those earlier years. If you are a sole proprietorship or a partnership, you can become an S corporation so that you can pay yourself reasonable wages. If you are considering becoming an S corporation, please make sure that you check into the negatives of becoming an S corporation first, because it may not be worth it to make the change. Remember, you can also receive a 20% QBI deduction on qualified real estate investment trust dividends. The nice thing about these dividends is that they are not limited by W-2 wages or depreciable assets. So, you could consider operating as a real estate investment trust, or REIT for short, but there are a lot of compliance and maintenance requirements for a REIT. Before we get into other tax strategies, I do want to point out that anytime you use a strategy to reduce your business income, you will also reduce your QBI deduction. So most of the time, these strategies are used when you believe that you will have a reduced deduction or have no QBI deduction at all. Now let's discuss some strategies that you can use if you are a specified service business offering personal services. If you have a business that has both specified service business income and non-specified service income, then you could consider separating the business into two separate businesses. This will keep the QBI deduction for your regular non-specified service income from being hindered by the personal service business limitation. For example, if you are a consultant and you also develop and sell your own software for your consulting clients, you could form a business for the software sales and a separate business for consulting. If you have a specified personal service business and you are married and your joint taxable income is over the limit, you could consider filing separately if filing separately will pull you back into range to get a QBI deduction. Here's a tax strategy that you can consider if your business is a partnership. If you're in a partnership and you're receiving guaranteed payments, you should stop paying yourself guaranteed payments. Guaranteed payments mean that you get paid regardless of your profits. These payments don't count as qualified business income, but the payments do count as taxable income. This is a double whammy because it decreases your QBI income and can possibly push you over the taxable income limits. In order to increase your qualified business income, you should switch to receiving a profit allocation and take deductions instead. Getting paid out of profits versus saying that you get paid regardless of profits will increase your QBI deduction. If you make this change, please also be sure to revise your partnership agreement to indicate that partners will receive distributions instead of guaranteed payments. If you anticipate that you will be over the taxable income threshold limit on your personal return, here are 5 tax strategies to consider in order to reduce your taxable income. 1. Your business can purchase assets during the year and use bonus depreciation in Section 179 to write off most or all of the cost of those assets in 1 year instead of over multiple years. This will give you more expenses and bring your income down. You can also use this strategy if you are over the second taxable income limit, whereby your qualified business income deduction is based on wages and depreciable assets. In this case, not only will you have a decrease in income, but depreciable assets will be increased, which will give you a larger QBI deduction. 2. Consider delaying receipt of any income that can be received in a later year. 3. Make a tax-deductible retirement plan contribution. 4. If you itemize your deductions, you can prepay some or all of the charitable contributions you were planning to make next year. You can even consider donating some of your stock investments. Donating stock to charity will increase your charitable contributions, decrease your taxable income, and eliminate future capital gains taxes since you are removing the stock from your portfolio. And 5, if you have capital gains, to offset these gains, you should consider selling any of your losing stock before year end. Capital gains are not good for the QBI deduction. Capital gains are included in your 1040 taxable income, which can push you over the income limits. Yet, if your business has capital gain income, the income is removed when calculating your QBI deduction amount. So if you have losing stock that you want to get rid of anyway, selling that stock could reduce your capital gain so that you can take a QBI deduction. If you need to know more about this capital gains offset strategy, please take a look at the video on your screen. Thanks for subscribing and taking the time to watch, but this was not official tax advice or legal advice. Hopefully this video will give you some ideas to present to your tax advisor so you can discuss solutions for your individual situation. Although I may not be able to give you official advice, feel free to ask me a question in the comments section. See you next time.